There is a particular cruelty in the way the American tax code conducts its business with retirees. It does not arrive at the door with a warrant. It sends no herald, raises no alarm, and delivers no advance notice that the rules governing the most financially consequential years of a citizen's life have been quietly, methodically, and consequentially rewritten. The revision simply occurs, buried inside the legislative architecture of a 1,000-page bill that no one outside a congressional committee room will ever read in full. And then life continues, undisturbed in its surface appearance, while underneath the numbers have shifted in ways that will determine, by tens of thousands of dollars per year, how much money actually remains in a household that spent 4 decades earning it. Consider what this means in practice. A retired couple in, say, Scottsdale or suburban Philadelphia has spent the better part of a year making decisions about when to draw from the IRA, about whether to trigger a Roth conversion, about what income to recognize and what to defer, based on a picture of the tax landscape that is no longer entirely accurate. Not because they are careless people, not because they failed to consult professionals, but because the professionals themselves often lag the code, because financial media is slow to translate legislative complexity into household arithmetic, and because the IRS, whatever its other considerable virtues, is not in the business of personal notification. This is what changed, and it changed in ways that cut both directions, creating opportunities for the informed and penalties for the uninformed in roughly equal measure. The One Big Beautiful Bill Act, signed in the summer of 2025, accomplished something that had been the subject of anxious speculation in every financial planning office in the country for years. It made the individual income tax provisions of the 2017 Tax Cuts and Jobs Act permanent. The sunset that was supposed to arrive at the end of 2025, clawing back the expanded standard deduction and returning millions of households to less favorable treatment, did not arrive. The expanded deduction survived, it was codified, and then it was augmented. Here are the actual numbers, and they deserve to be stated precisely, because precision is where financial planning either lives or dies. A married couple, both over the age of 65, filing jointly in 2026, commands a base standard deduction of approximately $30,200. To that, the tax code appends an age-based enhancement, currently around $1,600 per qualifying spouse, so $3,200 for a qualifying couple. And then, in a provision that has received remarkably little coverage outside of professional circles, the One Big Beautiful Bill added what has come to be called the senior bonus deduction, $6,000 per qualifying individual, or $12,000 for a couple in which both spouses qualify. The income phase-out for that senior bonus begins at $75,000 of modified adjusted gross income and extinguishes entirely at $175,000, meaning it phases out gradually across a $100,000 range of income. Add those figures together, $30,200 plus $3,200 plus $12,000. The sum is $45,400. That number represents something genuinely remarkable, a corridor of income that a qualifying married couple can receive or withdraw in a given tax year and owe the federal government precisely nothing, not less than they expected, not a reduced amount, nothing, zero. A legally correct, completely compliant federal tax bill of $0, available to any household that understands the architecture well enough to use it deliberately. For a single filer over 65 meeting the income qualifications, the corridor is smaller but hardly trivial, approximately $15,100 in base deduction, plus the $1,600 age enhancement, plus $6,000 in senior bonus deduction, for a total approaching $22,700 of income that can be received without federal tax consequence. The strategic implication of this is not subtle. Between the day a person retires and the day the IRS compels withdrawals through required minimum distributions, which begins at age 73 under current law, there exists a window of time during which the retiree controls the timing and size of their IRA distributions. Used with deliberate intelligence, this window allows a household to draw from pre-tax retirement accounts, fill the zero tax corridor each year, reduce the future balance that will be subject to forced distribution, and potentially shift assets into Roth accounts at rates that will never be available again. Ignored, that window simply closes, and the IRS arrives at 73, with a formula the account holder did not design and cannot override, frequently pushing income into brackets that years of careful extraction could have avoided entirely. The households that understand this are using it. The households that do not are leaving money, real, substantial money, on the table each year, not because the law denies it to them, but because they do not know it exists. That asymmetry is, if one is being honest about it, one of the more elegant features of a tax code that was not designed to be navigated without professional assistance. even as it is increasingly encountered without it. If you find this kind of information valuable, the kind that does not appear in the morning paper, that your broker may not have called to discuss, that sits in the plain language of IRS publications while remaining invisible to the people it most affects, then do yourself the particular favor of subscribing to this channel right now and turning on notifications. Because what follows in Part 2 and Part 3 of this discussion will alter the way you think about Social Security taxation, Medicare premiums, and the inheritance your children are about to receive or pay taxes on in ways that require context, not just headlines. This is the context. Stay with it. The Social Security provisional income calculation is among the most consequential pieces of arithmetic in American retirement finance, and it is also, by a considerable margin, among the least understood. It was designed in an era when its threshold seemed reasonable, written into law in 1984, and then left precisely where it was while the cost of living, Social Security benefit levels, and the general financial condition of American retirees changed substantially around it. The thresholds did not move. Everything else did. The result is that a larger proportion of retirees find themselves taxed on their Social Security benefits each passing year, not because Congress voted to increase their tax burden, but because the brackets were simply never indexed for the inflation that erodes the real value of a fixed dollar threshold over 4 decades. The mechanics of the calculation work as follows. A retiree takes their adjusted gross income, wages, IRA distributions, investment income, pension payments, whatever constitutes their taxable income before deductions, and adds to it any tax-exempt interest income they may have received from municipal bonds, for example. To that sum, they then add 1/2 of their annual Social Security benefit. The resulting figure is their provisional income. The IRS then compares that provisional income figure against a set of thresholds that have not been updated since the Reagan administration. For a single filer, if provisional income remains below $25,000, Social Security benefits are entirely untaxed. Between $25,000 and $34,000, up to half the benefit becomes potentially taxable. Above $34,000, up to 85% of the benefit enters the taxable column. For a married couple filing jointly, those thresholds sit at $32,000 and $44,000. Stated plainly, a married couple with $44,001 in provisional income may find 85% of their combined Social Security benefit subject to ordinary income tax. In 1984, that threshold caught relatively few retirees. In 2026, with average Social Security benefits substantially higher than they were 40 years ago, it catches a great many of them. And the interaction with the senior bonus deduction that Part 1 described creates a wrinkle that requires careful attention. The senior bonus deduction reduces taxable income. What it does not reduce is provisional income. These are different calculations, and the IRS runs them sequentially rather than simultaneously. A retiree who looks at their $45,400 zero-tax corridor and reasons that they can extract that full amount from a traditional IRA in a single year may, in the process of doing so, push their provisional income above the 85% threshold for Social Security taxation, increasing the amount of their benefit that enters the taxable column, even as the deduction protects other income from taxation. The two calculations interact. Doing one without accounting for the other produces an answer that is arithmetically correct in isolation and financially costly in aggregate. The discipline required is sequencing. Run the provisional income calculation first, using the expected IRA distribution amount as a variable. Determine how much of Social Security that distribution will pull into the taxable column. Then calculate the total taxable income, apply the appropriate deductions, and confirm that the net result is still at or near zero. Only then commit to the distribution amount. This is not exotic mathematics. It is arithmetic done in the correct order. The third change that is affecting retirees in ways that outrun their awareness involves Medicare's income-related monthly adjustment amount, IRMAA, in the abbreviation that has become a minor term of art in retirement planning circles, and the particular timing mismatch it creates between income events and premium consequences. Medicare determines premium surcharges using income from 2 years prior. In 2026, the relevant income year is 2024. If a retiree's 2024 modified adjusted gross income exceeded approximately $106,000 for a single filer or $212,000 for a couple filing jointly, their 2026 Medicare Part B premiums are elevated above the standard rate. The standard Part B premium in 2026 runs approximately $185 per month per person, at the first IRMAA tier that climbs to roughly $259. At the highest tier, it reaches $628 per month per person. And for a married couple both subject to the highest surcharge, the combined annual premium impact exceeds $15,000 above the base cost. Here's the cruel irony of the 2026 IRMAA landscape. For many retirees, 2024 was not a year of elevated income in any meaningful sense. It was a year of a specific, non-recurring income event. A required minimum distribution that ran larger than anticipated, a Roth conversion executed in anticipation of a TCJA sunset that then failed to materialize, proceeds from the sale of a second property, an inherited IRA distribution driven by the 10-year rule rather than by any choice. That event appeared on the 2024 tax return. Medicare read the return, and in 2026 the premium is elevated, based on income that no longer exists, from an event that will not repeat, reported by a document that is now 2 years old. The mechanism for addressing this is a life-changing event appeal filed on Form SSA 44 with the Social Security Administration. The form requests that Medicare substitute a more recent tax year for the one being used to calculate surcharges when a qualifying life change, retirement, loss of a spouse, loss of pension income, or a genuinely non-recurring income event explains the discrepancy between the income on record and current financial reality. These appeals are processed, they are granted with reasonable regularity, but they require the retiree to know the mechanism exists, to gather appropriate documentation, and to take the initiative. The retirees who remain unaware of it pay the elevated premium for the full calendar year. The window to act on 2026 premiums using 2024 income that may not reflect current circumstances is open as this is written. It will not remain so indefinitely. There is a passage in Alexis de Tocqueville's Observations on American Democracy in which he contemplates the particular danger of a soft despotism, one that does not break men's wills so much as soften them, that does not tyrannize so much as it encumbers and compresses, until citizens are reduced to nothing better than a flock of timid and industrious animals, of which government is the shepherd. Tocqueville was describing political power. He could, with minimal adaptation, have been describing the combined operation of the inherited IRA 10-year rule and the Medicaid estate recovery program on the American family in 2026. These two mechanisms, one federal, one a state-administered federal requirement, are, in their respective spheres, operating at their highest efficiency in living memory. Together, they represent the primary financial threat to the intergenerational transfer of wealth that the baby boomer generation is, at this very moment, in the process of attempting to execute. And the families most exposed to them are, in overwhelming numbers, the families who have not yet heard their names. The inherited IRA situation begins with the Secure Act of 2019, which eliminated the stretch IRA for most non-spouse beneficiaries and replaced it with a 10-year rule. Under this rule, a beneficiary who inherits a traditional IRA must empty the account completely within 10 years of the original account holder's death. This was sold, with some justification, as a flexible framework. Beneficiaries could take distributions in any pattern they chose, front-loaded, back-loaded, evenly spread, as long as the account reached zero by the end of year 10. What many beneficiaries were not told, and what the IRS clarified definitively only in final regulations issued in 2024, is that the flexibility of the 10-year rule applies only when the original account holder had not yet begun required minimum distributions at the time of death. When the account holder had passed their required beginning date, age 73 under current law, and was already taking RMDs, the beneficiary is not simply obligated to empty the account in 10 years. The beneficiary is required to take annual distributions each year of the 10-year period, calculated according to their own life expectancy, and then distribute whatever remains by the end of year 10. These are not optional withdrawals. They are required distributions, with a penalty of 25% of the amount that should have been taken for each year of non-compliance, reduced to 10% if the error is promptly corrected. The IRS extended penalty relief for missed inherited IRA distributions during the years of regulatory uncertainty following the Secure Act. That relief has expired. The rules are clear. Enforcement is in effect. Beneficiaries who inherited traditional IRAs from parents or grandparents who were already past their required beginning date and who have not been taking annual distributions may now be in a penalty position, compounding with each passing year. The mathematics of proper distribution planning here are not trivial. A beneficiary who receives a $400,000 inherited IRA and distributes the entire balance in year 10 faces an income event of staggering proportions, one that will almost certainly push them into the highest marginal brackets, potentially triggering IRMAA surcharges on their own future Medicare premiums, and creating a cascade of secondary tax consequences that careful year-by-year distribution across all 10 years would have largely prevented. The inherited IRA is not simply a gift, it is a tax obligation transferred, and the management of that obligation determines how much of the inheritance actually remains. The Medicaid estate recovery program operates on a different mechanism, but with comparable financial consequence for families that encounter it unprepared. Medicaid covers custodial long-term care, the nursing home care, the memory care facility, the in-home support for activities of daily living that Medicare categorically excludes from its coverage, but only for individuals who have spent their assets down to very low levels, typically $2,000 for a single person. And then, when the Medicaid recipient dies, federal law requires that states file claims against their probate estates for the value of benefits paid. The numbers involved are not small. Average nursing home costs in 2026 run approximately $105,000 per year for a private room and substantially more in high-cost markets. Memory care, which is what dementia patients typically require, averages between $10,000 and $14,000 per month nationwide. A 4-year dementia care stay, not an unusually long one, generates Medicaid expenditures approaching $480,000. When the care recipient dies, the state files a claim against the estate for that amount. The most common target is the family home, which is often the only asset remaining and which passes through probate in the absence of specific planning designed to prevent it. The child who anticipated inheriting a paid-off house may instead inherit a government lien. The protection strategies exist. They are legal. They are established in both federal and state law, and they are employed by families who had the foresight and the counsel to engage them early enough to matter. A Medicaid Asset Protection Trust, properly structured and established at least 5 years before a Medicaid application is filed, removes assets from countable Medicaid resources. A Ladybird deed, available in several states, allows a homeowner to retain full control of a property during their lifetime, while ensuring it transfers outside probate at death, removing it from estate recovery's reach. The Community Spouse Resource Allowance permits the healthy spouse of a Medicaid applicant to retain approximately $157,000 in countable assets, plus the home and a vehicle, without those assets disqualifying the institutionalized spouse from coverage. Every one of these strategies depends on time. The 5-year look-back runs from the date of Medicaid application, not from the date of facility admission, not from the date of diagnosis, but from the date of application. The families that act before the crisis do not find themselves in the parking lot of a memory care facility, signing admission papers, discovering that the planning window closed somewhere in the preceding years while other priorities intervened. The tax code in 2026 is not a conspiracy against retirees. It is a system of rules that rewards those who understand them and charges a steep price, silently and without apology, from those who do not. The zero-tax IRA extraction corridor is real and available. The provisional income sequencing that protects Social Security from unnecessary taxation is learnable arithmetic. The IRMAA appeal mechanism is a documented federal process. The inherited IRA distribution rules are now settled law. The Medicaid protection strategies have been used by careful families for decades. What separates the households that use these tools from the households that discover too late that the tools existed is not wealth, not intelligence, and not access to some privileged network of insider knowledge. It is information, delivered clearly, with specific numbers, in time to act on it, rather than simply to regret the absence of it. Leave a comment below with one word that describes how you felt reading this. Surprised, concerned, relieved, angry, motivated. One word. Because what gets measured in this community gets built on, and your answer shapes what comes next. The conversation in the comment section of this channel has more than once determined which topic gets addressed in the following episode. Your word matters more than you might assume. Take the time tonight to calculate your own zero-tax extraction space. Pull your 2024 tax return and examine the modified adjusted gross income line against the IRMAA thresholds. If you inherited a traditional IRA from someone who was already taking required minimum distributions, consult a tax professional before another year closes. If you own real estate and have not spoken with an elder law attorney in the last 3 years, make that call this week. The deadline for all of this is not a distant abstraction. It is the end of this calendar year, this quarter, this month, depending on which of the 5 rules applies to your situation. The math on acting now versus acting after the fact is not subtle, and it is not recoverable. And remember, this is for education and discussion only, not personal financial advice.